Hello and welcome to this episode of Mic'd Up with ICM. I'm Pete Seyler, a member of the business development team here at ICM. And today, in just a moment, I'll be joined by Ryan Leman, ICM's Director of Investments. Ryan, how are you today?
I'm doing great, Pete. How about yourself?
Great. Ryan, as a follow-up to our widely attended quarterly market update webcast yesterday, I know you brought a few topics to talk about and share additional information on. One from the economic section, one from the fixed income section, and one from our equity section. So without further ado, let's jump in. And I know you brought some charts today, so we'll get those up on the screen. And as we get started here, Ryan, I'm going to let you kind of take control, kicking off with something from our economic section.
Yeah, sure. So in our econ section of the presentation, the main theme this quarter really revolved around the health of the economy and how that aligned with that dovish pivot from the Fed that we saw in the latter part of 2023. And I think one of the most interesting slides relates to the labor markets, which, despite some headline numbers that appear pretty strong, have actually been softening when we look a little bit deeper into the data. So here you can see two metrics, with the orange line showing jobs per job seeker, that JOLTS number, and then the blue line illustrating just a 3-month moving average of the non-farm payroll. So the new jobs created on a monthly basis, just averaged over the prior 3 months. Now, if you look first at the JOLTS data, the number of jobs available per job seeker, it's declined pretty meaningfully from a peak of about 2 jobs to 1.34 today. So still a really strong number, with the number of available job openings creating plenty of negotiating power for higher wages, a situation that at the end of the day is ultimately inflationary. Now, non-farm payrolls, they've tended lower from a peak of 612,000 jobs created down to about 200,000 as of late. So from a historical standpoint, still relatively strong. However, lost in all this data is some meaningful weakness beneath the surface. So if we look a little bit deeper, in fact, 40% of the jobs that were reported via the jobs report have actually been revised away for 2023. So a meaningful reduction in what was actually created. And in addition, many of the jobs being added are part-time, while those being lost are actually full-time. So I guess the question is, what's more telling, the 1.3 jobs available per job seeker today, which is clearly more of a backward-looking type statistic, or more of that real-time weakness that's starting to show itself beneath the surface in those payroll numbers?
So great information. Let's transition a little bit and move forward with something from our fixed income section. You want to dive in here?
Yeah, sure. So on the fixed income side of the market, I really wanted to highlight credit spreads. So this slide shows your actual defaults against what is implied by the market's current yield and spread over treasuries. And the interesting thing here is that we can see that the orange line, implied defaults, it started to increase from almost 0% in 2021 to about 5.5%. Actual defaults began trending upward shortly thereafter. And this is what typically happens in practice. Implied defaults typically tend to lead actual defaults, what's actually occurring in credit markets. However, with the Fed's pivot, rates declining pretty substantially in that latter half of 2023, and then financial conditions subsequently loosening, we've actually seen implied defaults reverse course, while actual defaults have continued to push higher. So this really reminds us of that late 1990s period where implied defaults jumped, they briefly pulled back, and then they continued upwards as the economy slowed. And over that same period, actual defaults, they just continue to march higher, really without breaking stride. And it's tough to read today's situation as anything different. And just to put it into perspective, what that means is that spreads should be about 100 basis points higher than where they are today, based on what's actually occurring in credit markets, what actual defaults are. And even more concerning is that in a normal default cycle, defaults can easily reach double digits, which is about 600 basis points above where we are today in terms of spreads. So this leaves bond investors pretty vulnerable in a time when you really need bonds the most, which is precisely why we took the opportunity recently to reduce our overall credit exposure for the majority of our tactical strategies.
Great. Again, really insightful. One last pivot here during our time together. Let's hit on something from the equity section.
Yeah, absolutely. So I think this slide is really interesting because one common misconception around the relationship between the Fed and the stock market is that declining interest rates are going to propel stocks higher. And this is typically true over a more intermediate term time frame. However, it's not typically true in the short term. In fact, if we look over the last 30 years or so, there's actually been a good amount of pain for investors at the onset of a rate cut cycle. And the question is, why does this occur? Well, in reality, it's actually really difficult for the Fed to navigate a so-called soft landing or no landing type scenario. And historically, what's happened is the Fed has actually cut rates in response to unexpected economic weakness, which in turn typically coincides with declining equity markets and cheapening valuations. So if we look at the data on this slide, what you're going to see is that going back to the early 90s, we see 3 clear rate cut cycles, each of which coincided with some pretty meaningful market corrections. So during the early 2000s, you saw equities fall by about 46%. In 2008 to 2009, so the great financial crisis period, you saw declines in excess of 50%. And then in early 2000, we saw declines of just about 20%. Now, you did eventually see equity markets recover meaningfully, but this was after valuations had the ability to reset, and that stimulus that was provided by the Fed and by those cuts was actually absorbed by equity markets and the economy. Now, this isn't meant to be any type of doom and gloom type scenario, because there are a number of segments that we feel can outperform broad U.S. stocks during such a scenario, and we do actually walk through a number of those in the full presentation.
Great, Ryan, really appreciate the time today. I want to put it out there that if you have questions on the material that Ryan discussed today, we encourage you to pick up the replay of our first quarter 2024 quarterly market update webcast. That replay will be released very soon and should be available by the time you receive and have watched this mic'd up session. If you do have any additional questions, please always feel free to reach out at 888-426-4689 or via email at info@icm-invest.com. Thanks for joining us.